3-minute trader tip, 5 considerations to reduce the likelihood of false moves. As traders, we aim to get in at the beginning of a trend. Sometimes that does in fact move in our direction, other times it will fail to do so and the trading idea doesn't work. So our aim is always to increase the likelihood of what we would term a high probability entry, where it tends to have a greater likelihood of going in our desired direction. And there are perhaps some clues we can use to enable us to achieve that aim. The first, of course, is to utilize other indicators apart from price. Generally speaking, a price move in a direction with increased volume is thought to be more robust. Other indicators we may use are quite simple, and maybe it's over a specific EMA, so if we're going long, it might be we want it over a 20 EMA. We'd also perhaps check the RSI or relative strength index to see whether something's overbought or oversold. The second thing we can look at is to look at lines on other timeframes. As a general rule, breakouts through lines on longer timeframes, and even more so on several timeframes, tend to be more important than if on a single or shorter timeframe only. So say for example that we see a breakthrough resistance level on a 15, 30-minute chart and an hourly chart. That gives us far more likelihood, as there are more traders looking at different time frames, than if it was just, say, on a 15-minute chart. The concept of space is one that we've briefly referenced in other sessions. In a little more detail, some would suggest that a close price with some space between the signal to get in and where you actually enter may be prudent in terms of reducing moves which only just make it over a key level. So in order to be consistent, we need a way of doing this across the board, irrespective of time frame or instrument. So perhaps using a 0.5 multiple of the ATR above the key price point may offer a greater chance of a continued move in our direction. Fourthly, the proximity of the next key price point may be something worth considering. Let's take two stocks. Stock A, on a long trade, has a potential upside of $1. Stock B has the potential upside of $2. If market participants are looking at these two potential positions and see that there's more possible upside in the second stock, then that may attract more attention and hence more buying pressure, and so logically be more likely to continue that initial move, maybe keener to get into that trade. The fifth and final consideration is that of the proximity of an important data point. Arguably, volatility may increase pre-announcement of economic or corporate data as participants reposition. So hence, when looking at a potential breakout with maybe less than an hour to a GDP number, for example, you would expect markets to be quite choppy as that data point moves closer and closer, as some take off risk and some try to predict what may be happening next. So to give time space in between your particular entry and the next really important data point might be another way to reduce the likelihood of false moves. So what I want you to do is to look at these 5 and see if any resonate with you and perhaps are worth testing out in the context of your trading. Trade safe, and we'll see you again soon. Bye-bye for now.